Now we're going to go into the refined product space in a bit more detail, look at what was demand, what do we expect demand to be going forward, just because obviously this is always a moving target, trying to understand some of the different nuances within it. So we always want to kick off with the blended U.S. products supplied. And before we do that, we'd like to remind you, please like, share, subscribe. We've had some great success. We've had some new subscribers. So thank you again for your support and for sharing this, especially if you think it's valuable. So when we look at just the averages, so the current for this week in terms of the average is 15.17 million, which was versus last week of 14.283 million. Again, we had that kind of that overweight to the downside. Now we have that snapback. And then just because like the week before it was at 15.4. So you can see that we're really coming into this average of 15.1 as a very, doable, stable number. And when you look at just kind of where things are, again, as we've been talking about with seeing this peak of demand, that's what we normally have, where as you get into July 4th, you get into this peak period, and then you really go sideways, where there's not too much of a driver forward, and that's normally the case, especially when you look at the last 3 years of let's call it normalcy. But when you look at what's happening right now, we continue to see this sideways move, and that's something that we think is going to continue to hold true. Where next week we expect to see a gasoline increase. We think it's going to get closer to about 9.5. And, as we've been saying, it's going to average 9.3, but we think that there's going to be that spike up after being at 9.3. There's going to be an increase to about 9.5. And then we would expect to see a decline closer to that 9.3 and continue to see this sideways move. Now, as we get into the August months, the August month, that's where we're going to get a mix, because that's also a big vacation period. So the question is going to be, are people going to go and drive further away? And that's where we think we're going to get a bit more lumpiness, as we've been saying, typically Monday to Thursday being below average, and then seeing sometimes Thursday, but Friday to Sunday being above that average. When we look at some of the drivers in general. So when we look at Descartes as well, they have us at about 9.55, just about 9.6 in general. So that's where, again, we're seeing some of that drift higher. Gas Buddies as showing that we're going to see another increase as well. So that gives us this confidence that we are going to see that spike up. But you're going to see a bit of an offset as the builds are going to remain in gasoline, and this is what we keep talking about. We're just not seeing the drawdowns. Instead, we're just seeing either it go flat or increase, which is going to be kind of that problematic and shifting the way refiners are going to run and operate in general, which leads us to distillate. Because when we look at distillate, we just want to look at, okay, well, what are some of the opportunities? And as you can see on the smooth out, when you look at the last 29 years, you can see that we're very much in a steady increase. We typically have builds at this point in time. No one says it has to be in a straight line. It's just kind of this move higher. But when you look at this, you can see there is a lot of storage capacity available, where gasoline is still running fairly high in terms of storage. So why not get a little bit heavier? We've seen the increase in Nigerian barrels on those imports. We're seeing it from Saudi Arabia. PADD 3 is increasing their imports of heavy crudes. So that allows them to target a heavier cut of the stack, which means that we should see some small declines in some of the backdrops from gasoline and a small increase in distillate, which we're starting to see over that time period. So let's just look at, what are some of the production numbers. So here we have, gasoline production was flat at about 61%, which is a small decline on a production side, but fairly stable. And then when we look at distillate was up a small amount by just, essentially by 0.02%. So here's where we expect to see a little bit of a shift, where we would expect gasoline to drop to about 60%, and to see distillate production increase to about 31%. Again, not huge, but starting to see that pivot happen a little bit earlier than what is normal on a seasonal capacity. Now, typically, seasonally speaking, they're both increasing just because they're trying to produce as much gasoline. Typically, over the last couple of years, we've been at 96, 97% utilization rates, even as high as 98%. So this is where we're starting to get some of those shifts in general, while the European markets are buying more Middle Eastern and Asian product, which is going to cap U.S. exports. And this is where we're going to see some of that bifurcation, where some of the gasoline draw was supported by an increase in exports, but how that's being classified is a little fuzzy, because it's a little bit less gasoline and a lot more naphtha. But those are some things that we're going to talk on, those nuances, as we get into segment 3. So here, when we look at DOE distillate product supplied, we were saying we're going to get a spike back to the 5-year average. Here we are. Here, from this point forward, we expect it to go sideways, maybe even come down a bit along that 5-year average. We're not seeing too much. When we look at what is happening in trucking demand has pared back a little bit, but and we'll talk about this actually in the Econ show in a bit more detail, we're actually at a lull period. And it's because, and not to say that the ports are seeing a lull, but we're seeing a little bit of a lull because you've moved everything through. That was a little bit of a backlog. But now, as we go into August, that's where we start getting holiday push. And the holiday push is real, because it starts showing up in really the end of July, August, and carries us through November, December. And that's where we're going to see another increase in trucking. So we're going to get a little bit of a slowdown, and then that spike that we expect to see, and then carry us through the end of the year, which is going to be supportive of diesel demand. It's just right now we're fitting right within kind of that normal seasonal decline. And this is just playing out what we're talking about. So we do expect to see this stabilize, as we were saying last week. Instead, we thought it was going to stabilize a little bit higher. Instead, it came and broke that low. It's still going over the last 5 years. You can see it's still very high. And when you look at container levels and container demand going forward, using FreightWave sonar, Craig was kind enough to post it, and his team on Twitter, and you can see that there is going to be a big spike, and that's Craig Fuller for those that want to find him on Twitter. You're going to see that big spike in general. And again, we're not going back to these insane highs, because we have seen a certain amount of catch up on the rail side, but we're still going to have a lot of support to hold us in here. And rates are starting to come down a little bit. We're starting, not to say that labor's catching up, because it's not, but we're starting to see some hiring, even though some of the drivers are working longer hours. But again, there's some normalcy. And as we were talking about with rail did see a little bit of a catch up. If you remember last week and the week before, there were some of those wildfires that shut down some of these movements of cargoes, and that has now abated to a point. Things have reopened. Some of that movement has come through. UNP has slowed some movements from the West Coast into Chicago. That should carry through the end of this week and then get back to some normalcy. Again, as we've been saying, we continue to see intermodal remaining at elevated levels. When we look at grains, forest products, especially forest products and farm products, all of that's going to remain strong. As we were saying with petroleum products, we think it's going to stay within a 1% to 2% increase versus last year, especially with some of the driver issues that we've talked about and some of those nuances especially moving gasoline from the racks to the pump. Now, this is what we were discussing on the back end. If you look at, as we go through the rest of July into August is where we're seeing a big increase in TEUs, and that is that surge that is expected for the holiday season. So this is going to be supportive of resid or bunker fuel and diesel as we go through the fall and realistically winter months. Now on the heat side, it's going to get a bit toasty, especially across most of the U.S. You could see that some of the heat wave is now moved away from the Pacific Northwest. I'm sure they're thankful for it to be gone, or at least a bit more normal. As it bleeds further east into the East Coast, as you can see, as it goes all the way essentially over and down, Now, this is going to be a problem because it's going to increase some of the drought issues, which we're going to talk about in more detail in the Econ Show segment 1, which I think is going to be a bigger concern, especially when we're talking about yield. So then when we shift over a bit, here you can see the gasoline stock, gasoline drew by 112,000 barrels. There was an expectation to see a build. Now it's likely to see the build next week instead of this week. So this is going to be something to watch in general. But with that being said, what we've been talking about, and we've actually been saying it since March, builds were just going to go sideways. We weren't going to get a huge surge up, but at the same time, we weren't going to get draws down because we're still the best house on a terrible block to bring product. And that's what we're seeing again here. So this is where, even as demand has increased, again, below normal, but seasonally increasing, we're just not getting those draws. Instead, we've just gone flat. And when you look at how draws typically accelerate into the end of August, instead, we're just going to continue. Now, we will get draws overall through August because we will see refiners react. But we do expect to see one more build before we start to see some of that acceleration. And look at those imports. So those imports were up 330,000 barrels a day, 575,000 above the 5-year average. And it was driven by 318,000 coming into pad 1. That's 479,000 above the 5-year average. That was taking us from 830,000 barrels a day to 1.2 million. Now that will come down. That is not a doubt in my mind that's going to come down. But pad 5 had an increase of 105,000 barrels a day, 168,000 barrels a day above the 5-year average. That's going to remain a bit stickier. Now, both of these will always be lumpy. That's something to always consider. They'll be lumpy, but pad 5 is going to stay elevated in general. And then pad 1 is going to see a reduction, but we're not going to see this huge collapse. It's just going to be that steady move lower. And as we said 2 weeks ago now, there was a shift out of New York Harbor further south because there was just too much congestion and they were trying to spread out throughout pad 1 some of these imports. So that kept pad 1 elevated. It'll still stay strong, especially when we look at some of the European gasoline arrivals. As they came through, 57% increase week over week. Transatlantic gasoline arrivals rebounded 480,000 barrels a day, which compares to 306,000 the previous week. About 301,000 barrels of jet fuel also arrived. And then June loading shipments of clean fuels from Asia to the Americas rose to 280,000 tons from 210,000 tons a week earlier. This is, again, going to keep that pad 5 elevated. And then when we look, as we said in segment 1, Saudi Arabia is increasing flows into the U.S. West Coast. They're also increasing some flows into pad 1. That is where we're going to continue to see some of this elevated, where the Middle East is just sending more cargoes. And as we were calling for last week, Fujairah did have a fairly sizable increase in light disti. That's something that's going to continue. So they're going to look for places to put some of that additional product, especially when we look at the elevated storage levels that are in light distillate in Singapore. And that's really because of the problems that we're seeing on the west of Suez. So there's all of this available cargoes that are looking to find a home, and we expect to see some of this continue to move over. Now, this is going to be split between Europe and the U.S., but again, it's also going to take away some of that export capacity into LATAM. And some of the exports that we've seen so far are less about gasoline and more about naphtha, as there continues to be a broad shortfall of naphtha within Europe, which is just supportive of U.S. flow. Now, the other side that we just wanted to touch on is blending components had a build of 2.22 million barrels. So while gasoline is only 400,000 barrels below the 5-year average, blending components is 4.6 million above. And that's where it opens up the opportunity to import more more gasoline from abroad and blend it. So there's also that delay time, which again speaks to why we're going to have a build in gasoline, because you have to import it, you have to store it. Then as you're ready with it, you blend it and move it through the system. So the blending components continues to point to some of that softness in demand, and how refiners really overcompensated, as we said they would in April, when they converted really aggressively into making some of this additional blending component. Now, on the gasoline demand side, you could see that we did have a little bit of an increase. When we look forward, Gas Buddy so far, Tuesday U.S. gasoline demand rose 4.1% from the prior Tuesday and was 1.8% higher than the average of the last 4 Tuesdays. And then Sunday, gasoline demand rose 4.6% from the prior Sunday and was up 6.3% over the last 4. So U.S. gasoline demand rose 2.8% from the prior Monday and was up 0.6% from the average of the 4. So we're seeing a nice little bounce in demand that, again, will put us a little bit higher. We're not going to take out that July 4th number, but as we were saying, July 4th will be the high, and then we'll deviate, whether that is 1% above the 4-week average if we take out July 4th, maybe 1% down, but really working sideways in terms of just where that demand is in general. And just based on where it is, you're going to see a little bit of an increase versus where we were. And then again, rolling back down as we continue to see these adjustments overall. And the reason why is, well, let's look at gasoline prices. So gasoline prices are now $3.15 as of July 19th. They have now stabilized. So this is showing kind of that last push up. Now we have had oil prices flatline a bit. Now they've actually come back. So there's going to be some support to keep gasoline prices at this $3.15 level. And this is really at the peak of where we think we're going to start to see some of that degradation in demand. And then when we look at diesel prices, they continue to drift higher. They're now at $3.34 on their way to $3.35. And again, that's where we think that we're going to see a bit of a peaking out at that level as well. We thought it was going to be much closer to $3.30. Instead, we continue to see this push higher on a national level, keeping some of this elevated. Now, just digging in a little bit more into blending components, you can see that we continue to see this shift. And normally, if you look at this chart and the gasoline storage chart, they're very similar, but there was a little bit of a deviation this week, and now we think that there's going to be that adjustment. And when you look, you can see that the only time it was higher was against 2020. So again, we're still at, taking out 2020 at all-time highs on blending components. When we look over the last 15 years, that's taking in 2 recessions, if you want to count the blip that was the third. But here you can see that we're right at this 15-year average, and we continue to believe that we're going to be, again, this sideways move right around this kind of comfort level of the 15-year average. And then when we look at it against the last 4 years, you can see that there's typically a spike. So when we look at 2019, when you look at pretty much all of them, it all depends on when that spike happens. So in 2018, it was 2 weeks ago. 2019, it was this week, which just means that we're due for that spike up. And it's all about the movement of capacity. And where is that movement coming from? Now, we've talked about the structural issues with some of the shortages in truck drivers moving things from the racks to the pump. Some of that has been alleviated. Some of it still lingers in the market, which is creating some of that lumpiness. But this, again, opens up when we look at this historically, there is typically a spike. And that's why we think that getting to that 9.5, really kind of fits into where we see the market at this point in time, just below where we were in 2019. Not quite there, but again, moving more within that seasonal norm, but at a reduced level. And the reason why is when we look at some of the adjustments. So when we look at some of the activities, you can see that things are fairly flat. Residential still remains elevated. You can see workplace has gotten back to where it was. You can see the July 4th dip. And people are using transit stations at a at a steady pace. It is not exploding, but you're seeing a steady increase in transit utilizations, which is moving away from some of the needs to drive as there's a bit more comfort. Flex schedules have been rolled out. You're seeing some additional people in the office, but so far there's been some increases in COVID. So the question is going to be, are you going to see a little bit of a slowdown? But we expect to see some people getting back to the office in general, which is going to keep that transit station moving up. And you can see that parks have kind of normalized at this level, and there's not much that we think is going to change overall. Then when we look at Apple Mobility, you can see that based on where we are on the United States, we're right within this the top of where we were last year. You can see, and remember, last year was still well below where we are today. So it's important to keep that in mind. So we're above where we were in 2020, which again is a positive. And I don't think everybody expected to be above 2020. The question is how far above that 2020 level. And you can see that it's a pretty measured move, as most of the other regions, again, remain fairly fixed within their normal range, especially when we go across Europe. Now, when we look at propane had a build of 3.09 million, just about 3.1 million, 10.7 million below the 5-year average. We're now right in line with where we were in 2018. And as we've been saying, we expect to be very close and really kind of marry where we were in 2017, 2018. We don't see that deviating at all, really, from these levels. And then when we look at vaccinations, you can see the pace has slowed down a bit. We've had some slowdowns. The world is fairly steady. U.S. has slowed. India slowed a bit. Germany has slowed a touch, while France and Japan have increased. Again, some of those shifts. As we've been talking about, the U.S. is going to continue to slow because those who wanted it got it, and now you're getting this. Well, do I really need it? Things aren't that bad. So I think as you start to see the Delta variant news increasing, it'll keep some of the people moving through the process. But when we look at the share of people vaccinated, you can see that the U.S. has slowed down. Last week, the percentage was 48%. We're still at 48% with very little change in the partially vaccinated. And this is just, again, that net slowdown. And that's where, when you look at Germany, you're getting something similar. Spain, Italy, all of these are getting to, let's call it 50% to 55%. And then they're starting to tail off. And that's going to be... there's going to be a question of how do you kind of get past that number, and that's going to be some of the deviations that we'll see as we head into fall. Now, when we look at the share of people vaccinated on a much broader level, you can see Canada has accelerated. They're now at the partial level of 70%. They expect to be at that 60% by the end of next week. Again, 2 weeks from the last shot. And then when you look at the UK, some of the slowdown there. But when you look, again, U.S., France, Germany, Italy, Spain, Europe, and the U.S. are round out the top 5, which is good in terms of what we're seeing on the developed market side. The bigger issue, which is where we're talking about in terms of that flux of demand of 1.5 million barrels, remains at the emerging market level, which when you look down the curve below that world average, you can see a lot of emerging markets really struggling to get these vaccinations through the system, which is that delta for where we see some of those additional slowdowns on the demand side. Jet fuel had a build of 580,000, and then there's not much to say, just because again we expected to stay within this again chevron pattern, sideways, up, down, and to the right, which we continue to see overall. And it's really being driven by, we're coming to the peak of summer flying. So that's where you're starting to see North America roll over. You're starting to see Asia Pacific roll over, rest of the world. Europe is starting to starting to turn as well, because again, we're getting to the peak, and then we start to see that drop off. The average number of departures per day increased 390 week on week. This is slower than the large levels of growth over the past few weeks, because remember, the past few weeks, you're increasing for summer. Now we're past it. Now you're decreasing because you're coming past summer. And that's where we're seeing some of those adjustments, which is showing up in the 11 weeks forward. The passenger flight schedule for the 11 weeks ahead declined by around 1.5% since last week. And remember, each week has been a decline. EMEA cut more than other regions, 2.8% lower than this time last week. APAC cut 2.3% across the next 4 weeks as the region falls behind on COVID. So Asia Pacific is falling over the next 4 weeks. US and EMEA is falling over the next 11 weeks. So again, you're starting to see that top out and decline when we're looking at jet fuel. And here's where we are sitting, again, moving sideways on TSA passengers. We're still seeing that sideways move. We just see it as a very much a seasonal down move, as we're already seeing those declines on departures, which again is going to be some of that delta that we've talked about. Then we look at open table, regional breakdown. Again, weekends, 5% to 10% better. Weekdays, 5 to 15% worse. Continues to play out, so not too much to talk about there. Now, in the next segment, we're going to start off with OPEC and then go deeper into U.S. exports and what is happening on a broader level when we look at activity, when we look at storage on a refined product and oil basis.